Hello, everyone. We've been waiting for a few people to join in, but I think most people have come in. So let me officially start. Good afternoon, and thank you so much for joining us today for our webinar, The Why and How of International Investing. I am Shagun, and I'm pleased to be your host for this event. I'd like to take a moment to talk to you about our speaker. Our speaker today is Ashi Anand, the CEO and founder of IME Capital, a boutique wealth management firm. Ashi is an institutional fund manager with over 20 years of fund management experience at some of the top institutions like ICICI and Kotak. He has a proven track record of consistently outperforming the markets during the course of his career. Today, we are discussing international investing, the whys and hows, the benefits of geographic diversification, and how this can open up a wider range of investment options. Just so you know what to expect in the webinar, we will first provide an overview of the topic at hand, followed by a conversation about opportunities to invest in dynamic companies and funds globally. If you have any questions during the webinar, please post them in the chat section and we will address them at our Q&A session at the end of this webinar. So let's get started. Over to you, Ashi.
Thank you, Shagun. Thanks for the introduction. And I'd like to thank all the participants for actually attending today's webinar. This is a topic that we find very interesting at IME Capital. A lot of investors and a lot of wealth managers are quite comfortable nowadays with investing in India, be it Indian equities, Indian fixed income, etc. But according to us, investor awareness around investing internationally is still not as high as it should be. And it is something that we believe is very important from a portfolio construction and an investment perspective. So very happy to kind of be sharing this with you guys today. Without further ado, let me just kind of jump into the webinar directly. We'll be basically just in terms of the broad format, I'll first run through a quick kind of presentation which summarizes our views around international investing, and then very happy to kind of take a Q&A post that. So just starting with the presentation structure for today's webinar, there are 4 core points we'll be covering. Firstly, we will discuss why 100% concentration to India is not recommended. And this is something that we continue to see across a very large number of investor portfolios that we look at IME. We'll explain our reasons on why we think this is not necessarily a good idea, or if at all is happening, this decision needs to be taken consciously. We'll then look at what are the benefits of international investing. We'll take you through what are the various options that are available for you as an investor. And lastly, but this is also quite important, we'll take you through what the different routes are to invest overseas and what is the most tax efficient and the most optimal route if you wanted to build out a portfolio which includes international assets. So just coming to the first point around what is the impact of no diversification at an economic level. Before I dive into this, let me just spend a quick minute on this concept of level 1 to 5 investing that we have at IME Capital. So at IME Capital, whenever we are looking at funds and whenever we look at recommending funds to investors to invest in, it's always very important to understand certain underlying levels that actually drive how the fund is likely to perform in the future. So a fund is nothing but a container that will allow you to get exposures to certain companies. Those companies, in turn, the performance of that companies will be driven by the performance of the underlying economy, and the performance of that economy will be driven by certain underlying trends. We believe whenever you are building a portfolio, it's very important to look at portfolio construction from these level 3, 4, and 5 levels to ensure that concepts like diversification, concentration, risk, etc. need to be studied at all of these elements. For today's webinar, we're really focusing around level 4, economic growth, right? And the fact that when you're investing purely in Indian assets, you really have 100% exposure to what is the Indian economy. Now, while the Indian growth story is extremely attractive, we believe this is clearly over the coming decade, probably the most attractive market globally to be investing in. 100% exposure to a single economy is still not recommended because it does not adequately protect you against various tail risk. Now, this could include things like very sharp currency depreciation, capital controls, geopolitical risk, wars, political policy, regulatory risks. There are all kinds of risks that could emerge And a very important point, and I think this has been very well covered in the book, The Black Swan, which is quite a lot of investors are aware about this book. So the Black Swan basically speaks about events where extreme unknown and improbable and uncertain events tend to take place a lot more often than would be expected in the real world. So what you really are talking about when you're talking about Black Swan events is a very sharp kind of, and very often from a market perspective, you're talking of the very sharp corrections or sharp drawdowns you see in markets when certain unexpected things happen. Now, as of right now, standing as of today, there's no big uncertainty that we're seeing in the Indian growth story. You continue to be very positive about it, but it doesn't protect you against such large black swan events. Now, how real or not are these risks? We've just taken a few global examples, right, to show you that these things do happen, right? These large black swan events that can lead to large losses of investor capital has happened historically in the past across certain regions and geographies. So I think the best example from our perspective would probably be the Asian tiger, or the Asian currency crisis. What you saw between 97 to 98 was a very, very sharp depreciation across Asian currencies. Now, the reason we believe this is a very apt example is before 97, you actually had what were known as the Asian tigers. Asian economies were the darlings of the investor community globally. Very high growth rates across economies, favorable policies. The economies, companies were doing well, stock market returns were very strong. It led to a huge influx of capital into these markets. However, certain events, and I'm not going into the specific events that led to this, but that is described further here. And we can be happy to share the presentation with you. But certain events led to a risk of sentiment, where you saw a sharp pull back of capital from these Asian economies. This led to a vicious cycle where capital was flowing out, leading to currency depreciation. Companies which are leveraged in terms of foreign currency loans got even more badly leveraged, causing further panic, causing further drawback of capital. It was just a extremely dramatic unfolding of the Asian growth story. And you can just see the sheer quantum of depreciation that you saw in currencies over this period, leading to tremendous loss of investor capital. Now, it's not just in Asia. You've seen similar kind of crises unfold. You've seen this in Latin America, in the Latin American debt crisis between 1975 to 82. You've seen this in the Russian financial crisis in 98. More recently, you're kind of seeing this in terms of the Sri Lankan economic crisis, 2019 to presently. You're also seeing Pakistan starting to unfold. I would like to reiterate, it is not that we are talking about any such foreseeable risk in the Indian economy. We continue to be very positive about this over the longer term. The only thing is that when you have 100% exposure, you are not guarding yourselves against any large tail unexpected risk that could have some kind of a magnified impact in terms of the markets. And just to kind of highlight, it's not that you've not seen these kind of things in India. India has had its exposure to wars, political instability, civil unrest, economic events, such as the balance of payment crisis in 1991. There have been equity market scams. Now, effectively, the core point that we're trying to emphasize is that when you have 100% of your exposure to a single currency and a single economy, if anything were to happen that would derail that story, your entire wealth is at risk. And that's really what we're trying to protect at, and why we strongly recommend not having 100% concentration to a single currency and a single economy. Now, apart from this obvious guarding against of tail risk, what are some of the other benefits of international investing? Now, the first and most obvious benefit is really economic diversification. Economic growth across different economies differs based on various factors. Now, apart from these factors that we've outlined on the right, every economy also has certain specialized trends. There's certain underlying trends that would be driving growth in different economies, in different regions. As an investor, you sometimes have the ability to also invest behind these specific trends that could possibly be driving growth faster than others. Now, when we are looking at economic diversification, we've just taken 5 core regions on this particular slide. And as you can see, across India, US, China, ASEAN, and the Eurozone, there are very big differences in terms of the size of the economy, the GDP per capita, the population, the median age, what's happening in terms of demographics, and what are the some of the underlying themes that are taking place in these economies. When you start looking at portfolio construction as compared to only a single economy, as compared to saying I can diversify across kind of countries, you have the ability to really diversify quite significantly in terms of the maturity of the economies you're investing in, what's happening in terms of trends, what's happening in terms of demographics, etc. Now, as you can see, just continuing around this point on economic growth has actually differed quite significantly across different regions, depending on what's happening in terms of underlying factors at that economy. Various factors are at play, right? Population, investment, savings, productivity, political stability, etc. Now, while growth over the past decade has been driven by China, India, and other Asian economies, growth going forward could potentially be driven by other regions as well. Now, one core element is when you're investing in the markets, it's not just purely the economy that you're investing in. You have to take into account valuations. You have to take into account currency. You have to take into account what are the underlying themes that you can invest in. And when you start taking these into kind of context, really the value of international investing starts coming out even stronger. So if you're just looking at the benefit of diversifying at a currency level, what you have seen is over the past 2 to 3 decades, the Indian rupee has depreciated on average at about 5% on an annual basis. Now, while this is an annualized kind of a number, it's an average number. You'd actually have periods where the rupee would be depreciating faster, and you actually saw a fairly long period where the rupee actually wasn't depreciating it that much as well. Now, from an investment perspective, it's really rupee depreciation, which is a risk for you, not rupee appreciation. But in a scenario where the rupee were to depreciate, if the rupee starts depreciating at a faster pace than it has in the past, a lot of your purchasing power from an international context starts getting impacted, right? And which is where one of the things we've tried to show on this particular slide is while different economies, so we're just showing major global markets and what the last 10-year annualized returns have been in local currency terms. When you convert local currency terms to dollar returns, right, the actual returns being made across different markets can change quite dramatically. So while India has really been the strongest market in local currency terms, it's actually the second performing market in dollar terms. You would actually have done better investing in the US over the last decade because of the combined benefit of the local currency index returns accompanied with the appreciation of the US dollar. Another couple of examples which are kind of relevant, right? If you just look at Taiwan, there's a big gap in local currency terms, but the gap is virtually completely narrowed when you're looking at it in dollar returns. What happens is when you invest internationally, you start building a certain amount of your portfolio and assets that are not just denominated in Indian rupees, helping protect you against risk of sharper depreciation in Indian rupees over the longer term. The last key element is that when you're investing internationally, what happens is markets tend to be efficient. So it is very clear that the growth dynamics of the Indian economy and the growth dynamics in the US, especially driven by US tech, are superior to the growth dynamics of many other regions in the world. But this tends to get captured in terms of valuations. Now, so India and US justifiably trade at a premium to all other global economies. However, there can be times when this optimism around certain of these economies becomes a bit overextended, and the growth quality value equation starts becoming more favorable in certain other economies. So what happens is by building an international portfolio, you also start building in some level of diversification in terms of how expensive are the markets that you're investing in, and some level of diversification in terms of growth versus a value theme. Just a last kind of element around the benefits of investing internationally. And this is something which is very important. There are a number of very interesting trends and sectors which are driving growth globally. But these trends are not really investable in from an Indian market perspective. So if you're looking at semiconductors, if you're looking at electric vehicles and the entire autonomous driving movement, biotech, genomics, artificial intelligence, robotics, it's not really the Indian economy or Indian firms that are driving cutting edge kind of work in these fields. if you want to really get exposure in your portfolio to some of these interesting trends, you really do need to start looking at building some of these exposures directly in some of these international companies or into funds that are investing into companies that are direct beneficiaries of these themes globally. Another core element is a number of investors where we build financial plans for investors have certain parts of the expenses that are likely to be denominated in global currencies. A very common example is investors wanting to possibly send their children abroad in order for higher studies. Now, those expenses are going to be in, say, for example, the US dollar. You probably don't be saving for that in Indian rupees because again, if there's a very sharp depreciation around the time when your kids have to go overseas, you really take a very big hit in terms of the depreciation. So building for global expenses with global assets is something which probably makes a reasonable amount of sense. So that just broadly kind of covers what are the various benefits, according to us, for investing overseas. Now let's just move to the next section, where we are looking at what are the broad investment opportunities that are available to you. Now, I just want to highlight before I jump into the section, there really is a very, very large range of options that are available. What we've tried to cover here are some of the larger asset classes, some of the more prominent regions, some of the more prominent trends, themes, etc. But this is just a snapshot of what is available for you as an investor sitting in India to invest globally. Now, let's just start with the United States. This is clearly the largest and one of the most attractive markets globally to be investing in. Now, what makes the US continue to be one of the most attractive global markets from our perspective is a very large value creation that you're seeing in terms of US tech stocks. Now, this secular growth potential of US technology keeps interest in this market alive despite fairly high volatility that you've seen in recent times in the space. Now, according to us, as inflation starts to come under control and with the interest rate cycle close to peaking, right? So there are a few headwinds currently for the US, and that's kind of reflected in some of the volatility you're seeing in the markets in the nearer term. So growth is likely to remain subdued in the current year, but the longer term dynamics of this markets remains very strong. And being the largest economy globally, it's a very large investable circle. There's a very large amount of investments this economy can sustain. And you clearly have some of the best companies globally being present in these markets. Now, just to give you some context of some of the underlying trends of what's happening in terms of the United States, what you have seen, and we will allude to this a couple of times over this current webinar, is that technology is really driving a very large amount of the value creation in the US. And according to us, investors looking at investing in the US may actually consider investing in US technology funds, giving you more concentrated exposures to that part of the economy, which is actually clearly driving disproportionate growth. Now, you can see this disproportionate growth in terms of the way the Nasdaq has outperformed either the S&P 500 and definitely extremely strong outperformance to the overall global markets. Now, one of the other elements is because of the pure funding and innovation culture in Silicon Valley, it continues to be unmatched in terms of a source of innovation from a global context. Because of that core trend, new emerging technologies are likely to continue to come out from the US markets, right? And which is why if you're really wanting to invest in emerging technologies, I think the US is a very difficult market to ignore. We've just taken a couple of examples. If you're just seeing the way the NVIDIA stock has benefited from the rise of artificial intelligence, or the kind of Tesla, the kind of value creation you've seen in Tesla, with them really leapfrogging or spearheading the whole EV transition phase, right? You really get exposures to some of these very attractive companies when you're investing via US dedicated technology funds. Now, China would be the second largest economy globally. Now, while probably sometime back, this would have been a very interesting market to be investing in, it currently, according to us, falls into an extremely high risk reward deep value bet. Longer term, the Chinese economy should have the potential to grow, and it clearly is an extremely dynamic economy. However, adverse regulatory action and very clear signs of trouble in the real estate sector, which is a very important component of economic growth in China makes us a bit circumspect about investing in this market at this point in time. Regulations can basically take away very large amounts of wealth for investors, as we'll show you in the next few charts. Now, because of this underlying dynamic, while we are aware about the longer term economic growth that China has delivered, the sheer dynamism of that economy, it's really adverse regulations and real estate trouble which is making us a bit cautious about investing in this market at this point in time. So with the exception of very aggressive investors who are willing to take deep value investment calls, which is it's a higher risk reward way of investing. It's a very interesting investment approach for people with the right risk appetite who are okay dealing with very high levels of volatility. But with the exception of that, we aren't really recommending China at this point in time. Now, what you can really see if you're just looking at China over the last decade, while the economy would have grown tremendously, you've really not seen any value creation in terms of the MSCI China index. You're really pretty much just 9% up over almost a decade. Now, what has impacted growth, and if you're seeing this very sharp kind of pull down from 2021, you've really seen very sharp drawdowns in terms of Chinese tech. We've just shown Alibaba and Tencent as examples here. This was driven by adverse regulations around the technology sector. And you've also seen a very sharp collapse in terms of various real estate companies because of troubles that they're facing around leverage and demand. So China is a market that we are cautious on at this point in time, though deep value investors could definitely consider some kind of allocations to this market. ASEAN or the Asian region is something which we find quite attractive at this point in time, primarily in terms of the balance that you're seeing between valuations and growth. Now, according to us, there are clear recognized headwinds to these economies at the current point in time. Currencies have been depreciating. Economies are a bit weak, especially because a lot of these are export-oriented economies. And with the global economic environment being relatively muted, also export a lot to China. China growth is low, right? So the whole export-oriented theme is not firing at this point in time. And a lot of that is really what's being fully priced into markets. But according to us, what this gives you a bit of an opportunity. Because as inflation cools off and Fed rates kind of peak and you start seeing interest rates starting to come down, some of these trends will start reversing. The strength in the dollar could reverse. You could you could start seeing some of these currencies starting to kind of do better. The economy should start kind of benefiting from a expected global recovery as we go into next year. And by investing today, you're really being able to buy into these companies at very attractive valuations. And there are some very high quality companies that actually exist in these regions. Now, what you are seeing in Asia is a trend very similar to what you're actually seeing in China, right? Over the last decade, you've really not seen value creation in this market. In dollar terms, the market's up just 9% over a decade. Now, it's important to understand that while you're not seeing value creation, you do not have the same level of problems in Asia that you're seeing in China, right? The economies have grown quite strongly over the last decade, but this has not been captured in terms of performance of the markets. Now, accordingly, these markets are available across the board at valuations that are honestly quite attractive. You can invest into the Hong Kong, Korean, Shanghai, Singapore, Indonesian, overall EM Asia. All of these markets are trading at sub 12 times forward earnings. And that honestly is quite attractive given the longer term growth and quality that these regions offer you. So Asia is a market that we are actively kind of recommending investments into. Now, the last region that I'd like to just discuss is the European area. Now, while economic growth and economic growth weakness is well understood, Europe continues to house some very high quality companies that are actually servicing global demand, and especially in the consumer, manufacturing, and the pharmaceutical segments. We've just given some examples of some of the kind of companies that we are alluding to. So while growth at the economy level may not be strong, because these companies are actually servicing global demand, they actually benefited. Their growth is not really dependent on what's happening in Europe per se. And because of that, you've actually seen these markets do relatively not too badly. over the past decade, especially if you're looking at the DAX and the DAX and the CAC. You have seen kind of specific companies in consumer, certain companies in healthcare and capital goods also generate quite attractive value for investors. So it's a region that we believe is, while we are aware about the weaker underlying economic growth, if you're looking at Europe, it's important to understand that the companies in Europe aren't really dependent on the European economy for their own growth. And value creation can still happen in this particular region. Now, lastly, and this is something which is quite attractive, when you're investing globally, you don't have to invest just purely in diversified funds investing into a region per se or a particular country. You have some very interesting thematic equity funds that can give you direct exposure to certain underlying themes that are attractive in terms of value creation from a global perspective. A few examples could include fintech, clean tech, healthcare in the pharma space, what's happening in terms of big tech, semiconductors, the whole EV space, autonomous driving machines, biotech, genomics, artificial intelligence, robotics. Each of these themes have very interesting underlying growth dynamics. And you do, as an Indian investor, have the ability to invest in funds that can give you dedicated exposures to such underlying themes. Now, just lastly, we have tended to focus a bit around equity so far in terms of when we're looking at the investment options. But it's important to understand that when you're investing globally, similar to India, you aren't just limited to equity investing. There are a wide range of investment options across asset classes. Now, this would include life settlement funds, which are a form of purchasing of life insurance. It's very attractive, low risk investment opportunity. Long short funds, fixed income, this private equity, venture capital, quantitative based strategies, macro hedge funds, multi-asset hedge funds. They're honestly a very, very large range of asset classes. Now, this is really where your relationship manager at IME Capital can really help understand your particular risk profile. What is it that you are really trying to seek? What you're trying to gain exposure to in terms of your investment mandate, and really help identify what are the specific areas that you should be building out exposures to. Just the last part of today's kind of presentation is how exactly do you go about investing internationally? Now, if I'm going to ignore the gift city here primarily because according to us, the gift city is still in very early stages of development and the market ecosystem has not yet fully developed. It could become a very interesting route 3 to 5 years down the line, but possibly not the best route as of today. Now, gift city, you're really looking at 3 core ways that you can get exposure to international assets. The first is where you invest directly via a US broker. Now, this is something I think a lot of investors are aware about, right? You can open, and there are a lot of brokerages in India that have this on their platform. Kotak would have it, HDFC would have it. They're very large numbers. So you create an international broking account, and you could, people like HDFC and Kotak can all help facilitate this. And what you effectively do is you end up opening an underlying brokerage account in the US. Typically, this is with some kind of underlying US broker, such as Interactive Brokers or Stockal, etc. So while you may be using your common login of your existing broking platform to actually be investing, it's important to understand that your money is actually being sent overseas via the LRS route. And your money is parked in the US and is being invested via a US broker. Now, the reason we strongly recommend against using this route is that this route basically exposes you to estate duty risk. In case of the death of the investor, any assets that you're holding in what are called US cited assets, right? So these are assets that are held in the US and either a US company or US domicile fund, etc. 40% of all such investments will be taken above $60,000 will be taken by the US government in terms of inheritance taxes. Now, this is just a tremendous quantum of your wealth to be taken away. Since one can never really predict death, right? As in death is an uncertainty and it's a risk that you have to guard against from a portfolio perspective. We really see very limited value for anyone being willing to take on a estate duty risk when there are options available that protect you against that. The only kind of case where it probably has some value is if you're investing well under $60,000. So even after taking into account capital appreciation over a period of time, your wealth in the US will not cross that $60,000 mark. But with that exception, we strongly recommend investors don't invest directly into the US because estate duty risk is not worth getting into. Now you have another route, which are Indian feeder funds. Now this is basically mutual funds in India that you invest in, similar to any other mutual fund, any Indian-based mutual fund that you would be investing in. But these basically invest their money in overseas securities. So, for example, Motilal had a Nasdaq fund, Edelweiss had a bunch of different international funds. There are a number of mutual funds in India that have launched what are called international feeder funds. Now, this used to be actually our most recommended route until 1st April 2023. But after 1st April 2023, changes in how non-equity mutual funds in India are taxed have made these investments very tax inefficient. Basically, any gains that you make on any such feeder funds for investments you made after 1st April 2023, those gains will simply be added to your income and taxed based on your income tax slab. Now, anyone who's on a 30% plus kind of tax bracket, this just makes these funds very tax inefficient, and which is a large reason why at IME Capital, we are really no longer recommending Indian feeder funds. What we instead are recommending is a Singapore advisory structure that we've been able to open out. Right now, what this basically does is, according to us, get you the best of both worlds. You are investing overseas, your assets are held legally outside India, held in Singapore or via the underlying custodians via the structure. But because of the way that this is structured and when you cherry pick the funds that you're investing in, you have the ability to choose certain favorable fund domiciles that give you the exposures to whatever underlying investments or asset classes or themes that you want. But because of where these funds are domiciled, and really it's Luxembourg and Ireland that are the two most popular jurisdictions from a global fund perspective, you get no exposure to estate duty. So really, these are the kind of three structures that are available. The Singapore structure and the US broker structure, you need to use LRS, where a single individual can invest up to $250,000 a year to send money overseas for investments. A family of four, technically, if all the individuals are sending money overseas, can technically invest up to $1 million a year. Now, this has your assets moving outside the country and legally being held outside India, which has some benefits for certain types of investors. Now, what makes, according to us, the Singapore structure the most attractive is you want to be in a favorable capital gains taxation structure. Now, that is possible only when you're investing via LRS into international assets. If you're using feeder funds, your gains are going to be taxed based on your income tax slab, making just horribly, very badly inefficient from a taxation perspective. And secondly, you want to ensure that you are avoiding estate duty risk, which we can technically do via the Singapore structure by ensuring you're only investing in non-US, non-UK domiciled funds. The problem of US brokers is that if you're investing via them, 40% of all assets held in the US above $60,000 is exposed to estate duty risk. Just to kind of very quickly indicate in terms of how the route works, it's a very easy process. It's a completely online account opening process. It's a simple matter of getting some KYC, fetching CKYC details. An account can be opened in Singapore in a matter of a few days. Documentation is, again, relatively easy. And all kind of tax forms, etc., required from an India tax perspective, all of that is made easily available. So I think that just sums up my prepared remarks for today. Shagun, over to you. Happy to kind of take any Q&A that the participants may have.
Thank you so much, Ashi. So much of what you have said today, people might have discussed in a workplace setting or even like in a social situation. But listening to what you have said gives a lot of context. So I'm sure they have much more to talk about in those situations. We do have a bunch of questions. I'd like to start with the first one that came in. Tina wants to know, can you elaborate a little bit on current diversification and the black swan events that you mentioned?
Sorry, Shukla, can you just repeat the question?
Can you elaborate a little bit on current diversification and the black swan events that you mentioned?
Okay, sure. I am assuming the question is currency diversification and not current diversification. So I'm just
Yes,
kind of
currency
answering.
diversification. Yes, yes.
Okay, sure, sure. Okay, great. Okay, so see what we mean by black swan events. Now, I'll just give you a few examples. The subprime crisis, where subprime loans, which are considered to be very high quality assets at a point in time, suddenly went bad very, very rapidly, causing a collapse in global asset classes that you saw in 2008 in a very rapid manner. This is an example of a black swan event. These are large unknown events that can take place that can cause a very significant disruption to asset classes. Now, this is something that happens time and time again from a financial markets perspective. Over the last couple of decades, from a global perspective, you've seen subprime and you've seen COVID. These are two. COVID is again a perfect example of a black swan event. Unexpected, unknown, unpredictable, but a very, very large impact in terms of its impact on asset classes and investor wealth. Now, when we're talking about black swan events specifically from a currency perspective, you're really looking at something that happens in your particular economy that causes a run on your currency, that causes global investors to start pulling money out rapidly, and therefore a potential very sharp depreciation of the currency. Now, you've seen this happen across different currencies, different markets, multiple times in the past. So we showed this in Asia, right? What happened between 97 to 98 in Asia. I don't have some of the other data with me, but you've kind of seen this time and time again happening in Latin America, right? So places, a lot of Latin American countries basically have periods where there's suddenly big excesses that get created, of sharp run happens on the currency, and you see periods of very sharp depreciations. What we are talking about when we're talking about currency diversification and black swan events is saying that when you don't have, all your wealth is concentrated in the Indian rupee, if something were to happen to the Indian economy and the Indian currency, what could happen is unknown, right? Black swan by definition is unpredictable, but you can just hazard a few guesses. War between India and Pakistan, nuclear war between India and Pakistan, right? Some very sharp, adverse new regulations that come in, geopolitical risks, some form of civil war. There could be some very big financial market crisis, a major problem in our financial services industry, huge ramp up in terms of bad loans. There are different aspects that could take place impacting our underlying economy's growth story. Now, if something like that were to happen in India, and there's a sharp run on the rupee, and say the rupee were to suddenly go from 80 to 150, what happens to your wealth as an investor? You'd see very high inflation in India. Most things that we buy internationally would become twice as expensive. Your wealth as a client, as an investor, gets eroded. Now, that is basically what we're talking about, currency diversification with black swan events.
So Ashi, I think the next question is kind of related, because the next question also does relate to the same thing. And how do geopolitical events like the Israel-Palestine war recently and Russia-Ukraine last year impact the rationale to invest internationally? Am I not taking that risk?
So actually, honestly, I think it's exactly those kind of risks that you're semi-protecting against. So let me just break that up into two components. When I'm saying, first of all, that's the kind of risk that you're protecting against. Suppose you were a Russian investor or an Ukrainian investor. Suddenly war erupts. Your wealth can get very badly impacted. You could see something happening similarly in Israel and Palestine. Now, we unfortunately don't necessarily have the most friendly neighbors. There's nothing to say that India and Pakistan or India and China tomorrow can't have a conflict. And if the conflict gets particularly bad enough, a lot of wealth could be disrupted because of that kind of a conflict. So I think when you're talking about things like Israel, Palestine, when you're talking of things like Russia and Ukraine, it's important to understand that these kind of things can happen in India itself. And then having a certain amount of assets internationally can help protect against that risk. Now, secondly, when you're then looking at X, the fact that this could happen in India, how does Israel, Palestine, how does Russia, Ukraine kind of impact international investing? Let's just take Israel, Palestine as an example, because it's very near and thing. As of right now, this is more a localized problem. It's not a larger, it's not having a larger impact on the global economy. It will if the issue becomes escalates, pulling in other countries in the region and also possibly very large players globally, such as the US, Russia, or China get involved as part of what's happening. But at least as of right now, that's not happening. But if that were to happen, you'd probably see a very rapid escalation in crude prices, and that would clearly have an impact globally. Now, India imports a lot of crude. It will have a it could arguably have a bigger impact on our economy than, say, an economy like the US, which is no longer importing crude. So, as some of these events, so it's see, no one's really investing in Israel, no one's really investing in Russia or Ukraine. If if some event happens globally, you really try to understand that it could have some impact in India, it could have some impact in the US, it could have some impact in Asia. When you've diversified across these regions, you're actually protecting against some global event having an outsized impact on the Indian economy. So again, I think it just further kind of accentuates the case that there are uncertainties that happen. See, inherently, diversification helps reduce risk against uncertainty. So these uncertainties only just increase the requirement for investing globally.
Okay. Ashi, what's your take on de-dollarization and its impact on the international portfolio diversification, particularly in USA? This question has come from Yogesh.
So that's a very, very interesting kind of question, right? I think it's a little just difficult to say at this point in time, right? It just, while there are clear trends towards de-dollarization, these are still happening a bit on the periphery. I don't think we are anywhere close to a world where you can have any other global currency take on the US dollar's current mantle as the global currency of trade. Yes, you could have bilateral kind of treaties where you do some amount of trade on in certain other currencies. You could also move to certain forms of barter. But crypto is honestly just very, very far away. So from a much longer term perspective, de-dollarization could be a very interesting trend. It could open up all kinds of new opportunities globally. It would clearly have an adverse impact on the US markets and investing in the US because it's a very clear economic superpower that the US has. It's not really something that we are seeing as a real risk at this point in time.
Okay. Balaji wants to know what are the good themes to invest in currently, and also if I want debt exposure globally, are there any good options?
Okay, so that's an interesting question, right? So, some of the themes that we're indicating here, these are just some of the themes that we do find quite interesting globally. So, there are certain, and just to let you know what's available, right, in an easy manner for investors, there are certain dedicated funds that give you direct exposures to artificial intelligence. Dedicated funds give you direct exposure to US technology. Electric vehicles is a very interesting move, but you don't really know who's going to win that particular space. Will it be Tesla, or will some of the big auto be able to claw back the kind of lead that Tesla has been able to gain? Who's going to be the eventual winner? Will competition just wipe away margins? If you're confident of EV but not sure, not wanting to play by the OEMs, there's one of the funds on the platform which is a lithium ion mining fund. That fund will only invest in miners of lithium ion. Regardless of who wins, lithium ion manufacturers will do well. So that is, say, for example, a very interesting theme that we see. With the growth of semiconductors, 4G, 5G, the internet, smartphones, the need for computing power, you starting to use your devices are increasingly starting to become mini computers. Even in smart homes, even your fan and your light and your heaters and your ACs are all kind of becoming connected devices. The need for semiconductors will just keep moving up, right? So that's another interesting space. There's some very interesting trends happening in the healthcare space, especially in genomics. That's another interesting area to be investing in. Now, all of these trends have their own risk reward dynamics. Ultimately, the trend that is best to be investing in is a trend that meets your particular requirements as an investor, the spaces that you are the most comfortable betting in. It's important to understand whenever you're investing in a thematic or a trend based fund, these funds tend to have much higher levels of volatility than more diversified funds. It's only when you have that much underlying conviction in a theme that allows you to not react adversely to such volatility is when investing in these funds is likely to generate value for you, right? So, which is why I keep getting back to you really need to be discussing with your relationship manager to understand which of these trends suits you the most as an investor, because the answer differs a lot investor to investor. Coming to the point around fixed income, so globally you do have the traditional debt mutual fund type of funds which are available, and you're getting this across the board from low risk US treasuries. You can go and you can choose across the maturity curve based on what you expect to happen in terms of interest rates. So we find medium and longer duration US treasuries quite interesting from this point in time, because as interest rates start to come down, you could get quite interesting mark to market gains on these funds. So you have the ability to play duration in terms of US treasuries. You have the ability to try chasing slightly higher yields by going into corporate bonds, potentially even to high yielding corporate bonds. You can invest in debt funds focused on EM markets, for example, where yields could be a lot more attractive, but it's coming in with clearly higher levels of credit risk. So you have a very large gamut of traditional fixed income instruments available in these markets, but you also have other forms of what we like to call debt plus funds, right? These are funds that are not debt funds, but they resemble debt funds in terms of their risk reward. So you'd have certain kind of long short funds. You've got a very interesting fund category called life settlement, where it's really a fund that buys a very diversified basket of life insurance policies from actual underlying individuals. And it's an asset class which gives quite a consistent low teen return, where there's really virtually no exposure to interest rates, equity markets, or other such factors that tend to cause other funds to be correlated to each other.
Okay, thank you, Ashi. There are a couple of questions about estate duty. I'm going to combine them so that I can take more questions later. One person is asking, how come people have not heard about estate duties? I have been investing for the past 2 years internationally. Also, there's a question about estate duty. Does the threshold as well as taxation vary between geographies? If you could take those questions.
Shagun, so I think just it's quite unfortunate, but we've come across a lot of investors who've actually been investing globally. And where the platforms they've been using or the advisors haven't actually got this particular point. I'm honestly not sure why, as in it's a extremely important risk, which according to us needs to be front and center when you're asking anyone to invest internationally. As in, it's a very, very clear risk that people internationally are aware about. Because we don't have inheritance taxes in India, I think it's something that a lot of investors may not think about. And accordingly, certain platforms advisors haven't brought this to their notice. But there is no uncertainty. Estate duties are a real risk. If you have invested in the US, in what are US cited assets, these are basically assets held out of the US. If you are to pass away, any investments above $60,000 is 40% of that is taken away by the US government. Now, estate duties do vary country to country and region to region. It's also dependent on the route you've invested via. So the US, for example, has estate duties which differ from, are you a US citizen or are you an outsider investing in the US? If you're a US citizen, the cutoff is actually $5.25 million. So it's a lot higher, right? But if you're not a US citizen, it's a lower cutoff. UK also has a state duties, but there the cutoff is $325,000. Now, when you're investing internationally, in India, hopefully most investors are well aware about the tax implications of the investments. Whenever you're investing internationally, these nuances are extremely important. As long as you're careful on how you're doing it, it is actually quite easy to avoid estate duties. They are very sound, very well regulated jurisdictions globally, including jurisdictions such as Luxembourg, Ireland, Singapore. These aren't banana republics, these aren't tax havens, these are just very large global financial centers. If you're investing in funds that are domiciled out of these regions, you don't get exposure to estate duty, and you still get exposure to all the same underlying asset classes. So just to take this point one step further, right? You have Invesco has a fund called QQQ, which is basically a Nasdaq ETF. It's one of the most popular funds globally. You invest in this fund when it's domiciled out of the US. If you were to pass away, 40% of assets above 60,000 goes to the US government. You invest in the identical fund domiciled out of Luxembourg Island, and you don't have a state duty risk. I'm not sure if that answers the question completely, but I just want to reiterate that it's unfortunate a lot of people investing overseas have not been highlighted about this risk, but it is a very important risk that investors need to be aware about, and especially when it is a risk that is quite easy to avoid.
Correct. Thank you. Anish wants to know how LRS works.
Okay, so I'm not getting the finer operational technicalities of that, but basically LRS, which is the liberalized remittance scheme, is a program offered by the Indian government where you can invest up to $250,000 in a single financial year globally. So you can invest $250,000 this year, $250,000 the next year. And this is also per individual. So if there are 4 individuals in a family, the family combined could invest up to $1 million, each individual sending $250,000 globally. It's actually quite easy. You just have to instruct your bank to do what's called a SWIFT transaction. A SWIFT transaction is nothing but an equivalent of an NEFT or RTGS transfer at our end, where you're instructing the bank to basically do a transfer internationally. They will ask you to basically sign an LRS declaration form, where you're indicating that you will be investing less than $250,000 in a particular year. It's something which is actually quite, the first time you do it, it may be a new thing for you, but it's quite an easy and quite a seamless process.
Ashi, I'm going to quickly ask the last question. If the government loses the 2024 elections because opposition parties are offering freebies leading to bad policies and higher taxes, will that qualify as a black swan event? It's an interesting question from Amit.
So Amit, honestly, it's difficult to say, right? As in, without getting into politics or any of that. There's a lot of hype that goes into an election, and you sometimes see people behave a little more rationally post winning an election as compared to what they promised in the past. You can just go back to 2003, 2004, right? When the NDA government lost to the Congress, and you saw very, very sharp declines in the market. Would have been considered a black swan event, but you subsequently saw a very strong recovery, and you actually saw a very strong period of market and economic performance under the Congress kind of government. So policy and changes in governments are potential areas of black swan events. Whether if a 2024 election result would classify as that would really depend on a lot of different factors, very difficult to judge at this point in time.
Thank you, Ashi. That was a difficult enough question, but interesting. I think we have taken.
Just Shagun, just one additional thing, right?
Sure.
On Amit's thing. It's that's just one of many such examples of why we believe international investing is protecting you against such risk, right? It's not. I'd like to say I don't expect 2024 to be a black swan by any circumstance, but these are those unknowns, right? That could potentially cause changes that you may not have anticipated.
Um, for all the participants who tuned in, if you do have further questions, you can get in touch with us via our website. We're available here. Ashi has flashed the number on the screen as well. Thank you, Ashi, and thank you to all those who tuned in today. Feel free to contact us if you have any further questions. Have a great day, everyone. Thank you. Thank you, Ashi.
Thank you, Shogun, and thanks to all the participants for joining in today. Take care. Have a good day.